Hi traders, what's the outlook for the global indices? In this video, I'm going to show you some of the key drivers and the pushers on global indices and what to look out for. In this video, we're going to look at the world's global indices. Now, if you look at the global indices, you can see that they've all been on a steady push higher. Now, they've been pushed higher by two major factors. One, central bank policy. With central banks having had very low interest rates during the COVID-19 crisis, it means that debt is very cheap for companies. Companies can borrow money and it's easy for them to stay afloat and to keep trading and in business. This is called accommodative policy stance that makes it easier for stocks to keep rising higher. Now, on top of that, we also have the fact that there's been broad fiscal stimulus. So in other words, governments have been entering in to make sure that companies can pay workers, and they've been increasing national debt to support individuals and companies. So if you look at the S&P 500, for instance, you can see this strong move higher. Look how rapid the ascent in stocks has been from April 2020 all the way through to August 2021. Look at it. It's incredibly steep, it's incredibly sharp, and that rise in the S&P 500 has been echoed across many of the world's major indices. And what investors are realizing, and what investors have been saying, is this can't carry on indefinitely. Because eventually there should be a correction in stocks, and the ascent and the steepness has taken many people by surprise. If you remember at the start of the COVID-19 crisis, many investors thought there would be a V-shaped recovery. But because of the amount of quantitative easing, the low central bank interest rates, the broad fiscal stimulus, it's not a V-shaped recovery. It's more like a Nike tick. It's more like a tick-shaped recovery. And investors are realizing that this can't keep going on and on and on. So what's likely to be the catalyst for change? Well, the correction that is expected to come is likely to come on expectations of a US policy normalization. Once the US start raising interest rates, that makes conditions less accommodative for stocks, and that will be a simple and a straightforward time to see the stock market correct. So just to be aware that entering at these high levels doesn't make sense on the global indices. Instead, it's better to wait for a deeper pullback from support, or maybe consider one of the European global indices. In particular, looking at the FTSE 100, you can see that that still has that gap to fill. So one particular idea would be looking for a break of this potential trend line on the FTSE 100. If you get a break and close above this level on the weekly chart, it would be possible to buy at market, stop just below 70.63 and make a run for 7,500. Goldman Sachs, for instance, sees upside in the FTSE 100, and they project a year target, a 12-month target of 7,900. So at the moment, the global indices are very overbought, and many investors are worried. Warren Buffett, for instance, and his fund Berkshire Hathaway is heavily in cash because he sees so little value in the stock market at the moment. So that's a broad rundown of the global indices, including one potential trading opportunity that many analysts are eyeing, and also the circumstances that we need to look out for a correction in global indices, namely a central bank interest rate hike and move towards policy normalization from the US would mean that conditions are no longer so supportive for global indices, and investors should be aware and be looking out for a correction and only consider buying where risk can be carefully managed from very key levels of support.